All right, let's get right into it. Something truly extraordinary is happening in the silver market right now. And according to the analysis we're breaking down, it's a signal that the very idea of a price for silver might soon be, well, irrelevant. We're going to unpack a predictable historical pattern that could literally change everything.
It all starts with this number, 37.6 million ounces. That's how much physical silver has just vanished from the COMEX vaults in an incredibly short period of time. Now, to give you some context, this is the biggest and fastest drain of its kind since the legendary Hunt Brothers squeeze back in 1980. We'll get to them in a minute. And it's the speed here that's just mind-boggling. All of that silver, gone in only 47 days. This is not business as usual, folks. This is a dead sprint to get physical metal out of the system, and it points to an intense, almost desperate demand for the real thing.
And if that wasn't enough, the market has flipped into a state called backwardation. Now, this is a huge red flag. See, normally it costs more to get something in the future because you have to pay for storage. But when it costs more to get it right now, that means people are willing to pay a premium for immediate delivery. They need it, and they need it now.
The source material we're looking at doesn't mince words. They call it what it is. This kind of behavior, paying more for something today than you would for it tomorrow, isn't just investing. That's panic buying. It's a scramble to get your hands on physical silver before there's none left to get.
So, here's the big question. What if all this chaos, the vaults emptying, the backwardation, the panic, isn't chaos at all? What if it's just a set of symptoms? The argument is that these are all just predictable stages in a recurring historical pattern, one that plays out over and over again in commodity markets. So let's break that pattern down.
The whole idea is built around this four-stage framework. It basically describes the life cycle of how markets for real, tangible assets like silver get established, then manipulated, and then ultimately how they break. All because of the growing gap between the physical supply and the paper promise.
Okay, so here are the 4 stages. It's pretty straightforward. Stage 1, establishment. A real asset becomes trusted as a form of money. Stage 2, manipulation. Paper claims, think futures contracts, ETFs, get created, and they soon outnumber the actual physical supply by a huge margin. Stage 3, the squeeze. People start demanding the real thing, pulling physical metal out of the system. And finally, stage 4, the break. The whole paper market collapses because there simply isn't enough physical metal to back all the promises. Now, to show you this isn't just some abstract theory, we have to look at history. And there is no better example than the Hunt Brothers' attempt to corner the silver market back in 1980. It is a perfect, and I mean perfect, real-world case study of this 4-stage pattern in action. Just look at this timeline. It's absolutely insane. The Hunt Brothers started buying up enormous amounts of physical silver and futures contracts, and in a little over a year, they, along with massive inflation, drove the price from $6 an ounce to almost $50. That's a 724% increase. They were putting a serious squeeze on the physical market. But here's where it gets really interesting. The exchange, COMEX, was on the brink of failing because it couldn't possibly deliver all the silver that was being demanded. So what did they do? Did they find more silver? Nope. They just changed the rules in the middle of the game. They brought in something called Silver Rule 7, which said you could only sell, not buy, and they jacked up the margin requirements, making it impossible for the Hunts to hold their positions. And the aftermath tells the whole story. It perfectly highlights the difference between owning a piece of paper and owning the real thing. The Hunt brothers, who were using leveraged paper contracts, got completely wiped out. They lost over $1 billion and were forced into bankruptcy. But what about the people who just owned physical silver coins and bars? They suffered no losses. In fact, even after the price crashed, they were still up 66% from where the whole ride started. Physical ownership won. It's as simple as that. By the way, if you're finding this explainer insightful, do us a favor and hit that like button, share, and subscribe so you won't miss our next deep dive. Okay, so that brings us right back to today. And the core argument from our source is this. We are living through stage 3 of that very same pattern right now. The squeeze on physical silver is happening all over again. But this time, it isn't just a couple of billionaires. It's a global phenomenon. Let's just look at the hard data. This chart shows the registered silver in COMEX vaults. That's the stuff that's actually available for delivery. It is absolutely cratered, from 80 million ounces down to just 43 million in a little over a year. The source calls this a bank run on physical silver, and you can see it's only speeding up.
And here's the big difference from 1980. This squeeze isn't just about investment. It's being driven by massive, non-negotiable industrial demand. I mean, look at this. Silver is absolutely critical for solar panels, for electric vehicles, for 5G, for AI data centers. This isn't optional demand. This is the physical foundation of our modern world.
All that demand is creating a huge supply problem. This table makes it crystal clear. The world has had a major silver deficit for 4 years in a row now. We are simply using way more silver than we are mining and recycling. We're eating into the stockpiles, and that can't go on forever.
And the signs of this global squeeze are popping up everywhere you look. Major banks in South Korea have flat out stopped selling silver. China is making it harder for its own citizens to buy. India is importing record-breaking amounts, and maybe most telling, the premiums, that's the extra amount you have to pay over the spot price to get your hands on actual coins and bars, are rising steadily.
So, if we're deep into stage 3, what's next? Well, that brings us to the final and most dramatic act of this play, stage 4. This is the moment, our source argues, when the paper price of silver just stops mattering altogether.
In stage 4, the system simply breaks. Trading gets halted. Exchanges can't deliver the metal they promised, so they try to settle contracts with cash. The paper market turns into a total mess. And at that point, the question is no longer, what's the price of silver? The question becomes, can you even find any silver to buy, at any price? Availability is the only thing that will matter.
So what do you do? Based on this whole analysis, the source lays out 5 really clear takeaways. The number 1 point is to own the physical metal itself, not a paper promise of it. It suggests buying now before availability vanishes and premiums go through the roof. It recommends focusing on recognizable things like government coins, putting in an appropriate amount of your assets, and, this is crucial, storing it yourself. Take away all the risk of someone else holding it for you.
And really, the whole argument boils down to this one powerful idea. Every single paper currency system in history has eventually failed. But you know what doesn't fail? Real things. As the quote says, you cannot print silver. It's finite, it's real, and it's governed by the laws of physics, not the whims of economists.
And that really leaves us with one final thought from this analysis. All these signals, the faults being drained, the deficits, the backwardation, the moves by central banks, they're all pieces of a puzzle. They're telling a story. The market is telling you the truth. The only question is, are you listening?